Hey, what's going on everybody? Welcome back. It is Travis here with JT Wealth, and in today's video we're going to talk about 3 big dividend stocks with a good yield and even better analyst ratings. So let's get into it. Hey, welcome back everybody. Thank you so much for joining me. And if you're new to the channel, we appreciate you checking us out. Hopefully you find some value in today's video. If you do, remember to give us a big thumbs up and consider subscribing to the channel as well. For everybody who's usually coming to JT Wealth to see Julie, don't forget she is now on the TipRanks YouTube channel where she does her Monday through Friday pre-market morning update videos. So that's where you can see her. So if you've been watching the channel for a while, you should know that Julie and I are both long-term investors, and part of our investment strategy is big on dividends. So today's video is going to be talking about 3 dividend stocks that I found in an article recently that have a great yield and really strong recommendations from the analysts. Obviously, dividends are a fantastic way to continue growing passive income regardless of what the market is doing. So if you anticipate perhaps a decline in the market, that's okay because you're going to be able to reinvest your dividends, buy more of the stock that you're in at a lower price, and continue to receive those dividend payouts. And now before we dive into which 3 stocks we're going to talk about today, I just want to remind you guys to check out the links in the description section down below. Since we're talking about dividend stocks, I would recommend the M1 Finance link, which will give you access to the M1 Finance platform, which is fantastic for long-term set it and forget it dividend reinvestment plans. They have a fantastic pie that you can use to select your stocks, choose what percentage of that pie you want to go towards the stock, and then how much money you want to put into it weekly, monthly, whatever the case may be. You can set up your drip plan or your dividend reinvestment, and then you just sit back and let it grow. It's a fantastic option. Okay, and now onto the article showcasing these 3 fantastic stocks. Alright, and this article came off of TipRanks, and it's 3 big dividend stocks yielding at least 7% that analysts say buy. And this is premised off the fact that the S&P 500 has been up about 27% over the last 6 months, and that if you're anticipating a slight dip or deceleration into the market, judging because of the fact that we're going into the summer months, and it says that in the warmer months we tend to see a slowdown in the market, you might want to start considering using some long-term investment strategies, some value investing, or in this case, some dividend stocks to hedge against some of the volatility in the market. So the article goes on to talk about what they refer to as the seasonality effect. From November 1st to 30 April, you tend to have a historically very strong market. They then go on to talk about how approaching the summer months and anticipating that decline, compounded with some of the geopolitical stuff that's going on with China, with Europe, with the US dollar valuation, and how they're kind of anticipating a slight decline in the market as a result of all of these things. So Stifel's strategist Barry Bannister says this might be the perfect time to start considering a more defensive posture in your portfolio. So of course, dividend stocks are traditionally a defensive play, and they really help diversify your portfolio to help hedge against other things like we discussed, the growth trends that may start diminishing over the summer months. And then he talks about, of course, how dividend funds and dividend stocks tend to not do as well through a growth period and a bullish period, but they make up for it in bearish periods where they continue to provide that passive income through dividend payouts. So let's take a look at the first stock they're talking about today, Suburban Propane Partners. Alright, Suburban Propane Partners, ticker SPH, and they say the energy industry isn't all big oil. Households need fuel too, and that's where SPH comes in. The company got its start marketing propane for home use and has since expanded to offer a range of fuels and fuel oils, along with natural gas and electric utility services to the residential, commercial, and agricultural markets. The company is headquartered in New Jersey and boasts 3,300 employees and operations in 41 states to more than 1 million customers through some 700 locations. Their business shows a strong seasonal pattern, with the first and second quarters of the year having higher revenues and earnings than the third and fourth quarters. This was clear in the recent first quarter 21 report, with the pattern overlaid by losses due. Moving on, it says that on a positive note, earnings are more than sufficient to pay the regular dividend, which the company has recently declared for payment on May 4th. The dividend at 30 cents per common share annualizes to $1.20 and gives a yield of 8.2%. Suburban Propane has a long history of keeping the dividend payment reliable and of adjusting the payment when needed to keep it in line with earnings. 5-star analyst David Coleman acknowledges the company's weak points but sees it as an overall growth proposition. He says, although Suburban posted weaker than expected fiscal first quarter 21 earnings, reflecting unseasonably warm weather and the impact of the pandemic, we note that industry trends for propane companies are now improving. The company cuts its quarterly dividend in half to 30 cents per unit in July of 2020. However, we believe that cut was prudent and note that the stock still yields about 8%, which is attractive in low interest rate environments. To this end, Coleman rates the SPH stock a buy and has an $18 price target, implying an upside of 21% for the next 12 months. So now let's take a quick look at the TipRanks analyst forecast for this stock. An SPH comes in at a moderate buy with 2 buy ratings, no holds and no sells. You see again that $18 price target mentioned with a price right now of about $15.34 as I'm filming. So you've still got some good potential for growth here, as well as letting you collect on those dividends throughout as well. And here you can see SPH's dividend history. They are a quarterly dividend paying stock, and it shows that their dividend yields roughly 8.28%. So they're a solid dividend paying company, one you should definitely consider in your portfolio. All right, moving on to the second dividend stock, and that is going to be Rattler Midstream. So Rattler Midstream, like Suburban Propane, lives in the energy universe, but Rattler is a midstream company spun off of Diamondback Energy in 2018 to develop, operate, and acquire midstream assets in the parent company's operating areas of the Midland and Delaware formations of Texas Permian Basin. Rattler has been climbing for several months out of a deep hole caused by the COVID pandemic and depressed demand. Higher oil prices are helping the company, and in Q4, Rattler reported $109.2 million in revenues, up from $96.5 in Q3, but still down 12.8% from a year ago in the same quarter. EPS showed the same pattern at 21 cents. It was up from 19 cents in the prior quarter, but down 25% year over year. Covering Rattler for Raymond James, Justin Jenkins notes that while Rattler has only one main customer, it's an investment-grade, large-cap, near-pure-play Permian producer with scale. We expect RTLR to recruit slightly more generalist interest relative to pure MLPs thanks to its involvement with FANG. Jenkins goes on to explain why he believes that Rattler is a sound proposition. Once we move past 1Q of 21 noise, we expect 2021 to be a relatively quiet period of solid execution for Rattler. While the potential for a drop-down could create some headlines, we expect a relatively small, leverage-neutral, and moderately valued transaction that does little to shift the overall story. Increasing confidence in the FANG outlook will improve the relative standing of Rattler on a similar basis. Based on that, Jenkins rates Rattler an outperform or a buy and sets a $13 price target, indicating a 19% upside in the next 12 months. All right, so again, let's take a quick look at the TipRanks analyst forecast for Rattler stock. All right, so you can see RTLR here showcasing a $12 12-month forecast on the average. They have 6 ratings, giving it a moderate buy with 2 buys and 4 holds. Now $12 is just shy of the $13 that we were shown by the analyst previously, but this still is showing a 4.62% increase, down slightly from the previous $13, of course. Now the RTLR dividend history shown here, 80 cents on the year, 20 cents quarterly. That's giving them a 7.31% dividend yield. Something I found that was really exciting about the Rattler company was their 12-month history of how the stock has performed. So I want to show you guys that as well. All right, so check this out, guys. In the last 12 months, Rattler Midstream is up 80.56%. That is awesome. So far we've seen 21% possible from the first company, 19% possible from the second company, but that second company, Rattler's already had 80% on the year. So that could be why they're projecting a slight slowdown, but 19% is still a very solid return if that were to come true in the next 12 months. You're gonna get 19% there, maybe 21% on the first company, all while collecting your dividends. Okay, and on to the third and final stock today. This is a REIT, and it's Broadmark Realty Capital. So shifting gears, we'll move over to the Real Estate Investment Trust segment. That's a REIT. In a way, this is inevitable. REIT companies are known for their high-yielding, reliable dividend payments, dictated at least in part by tax regulations that require them to return a high share of profits directly to the investors. BRMK holds a portfolio of mortgages and mortgage-backed securities with a focus on construction and development. The company has funded over 1,200 loans over the past decade for an aggregate of more than $2.8 billion. In its most recent quarterly report for fourth quarter 20, Broadmark reported $194.8 million in loan commitments, generating $32.5 million in top-line revenue. So with plenty of cash and rising revenues and earnings, it means that Broadmark can afford its dividend. The company pays this out monthly and in April declared the May payment for 7 cents per common share. That annualizes out to 84 cents per share, giving investors a yield of 7.8%. B. Riley analyst Randy Binner, rated 5 stars by TipRanks, sees a clear path ahead for Broadmark's continued growth. Our view is that FY21 should see credit trends revert back to more normalized levels, which should be an added tailwind to net interest income. We see potential upside to the stock as the company continues to resolve defaults, grows the public REIT portfolio and provide private AUM, and gets the dividend growth story back on track in FY21. In line with those comments, Binner puts a buy rating on BRMK along with a $12.50 price target, suggesting a 15% upside for the next 12 months. And now, of course, let's take a look at the TipRanks price target for this stock. So BRMK coming in with an $11.75 average price target for the next 12 months. They're right around $10.89 today as of filming. They had a moderate buy rating with 2 buys and only 1 hold. Looking at BRMK's dividend history, you can see here that they are a monthly paying out company, paid about 7 cents per share, and of course the stock runs about $10 to almost $11 a share right now. Their dividend yield is 7.8%, and they have also had a pretty solid year. Looking at the last 12 months, they have a 37.83% growth in that last 12-month period. All right, but that's it for today, guys. Those are the 3 dividend-paying stocks that I am definitely going to consider for my dividend portfolio. Now, if you want to update on how our dividend portfolio is doing, please leave a comment in the comment section down below and let me know. That's, of course, the one where we've been putting $50 a week into only dividend-paying companies. So I'm going to look at these. I'm going to look at SPH and BRMK and consider which one of these could make it into our dividend portfolio. And then hopefully we can do an update video and bring you guys up to speed on how that portfolio is doing, as we have consistently put that $50 a week into that portfolio. So for anybody who's been following along for that, you should have about the exact same amount of money if you kept the same stocks in that we did. So hopefully we'll have an update for you on that shortly. And lastly, as always, just because these are stocks I'm interested in and stocks I'm going to look at doesn't necessarily mean they're an interest to you or that you should look at them. I'm not your financial advisor. I'm not a financial advisor. I'm not here to provide you stock picks. This is all just for information and entertainment purposes only. So please do your own due diligence before investing your hard-earned money. So that's it. Please leave a comment in the comment section down below. Let me know what you thought of these 3 companies. Are you going to take a look at them? Do you already own any of them? What are your thoughts on dividends as a whole? Please let us know in the comment section down below. We love hearing from you guys, and hopefully you all have a fantastic Thursday. Thanks for joining us. Take it easy.